Hi everyone. In this video, we are talking about the overall audit strategy under ISA 300, planning and audit of financial statements. By the end of this video, you will understand exactly what goes into building an audit strategy and how it feeds into the more detailed audit plan. Let's get into it. So, what does the overall audit strategy actually do? Establishing it involves five linked steps. First, the auditor determines the characteristics of the engagement that define its scope. Second, they ascertain the reporting objectives, deadlines, and communications. Third, they consider the key factors that will determine where the audit team focuses its efforts. Fourth, they consider the results of preliminary engagement activities and any relevant knowledge from other engagements. And finally, once all that is clear, the auditor can decide the nature, extent, and timing of the resources the engagement actually needs. Let's talk through each of these five steps in detail. Let's start with the step one, determining the characteristics of the engagement. These are the things that define the scope of audit. The first is the financial reporting framework being used. For example, is the entity reporting under international financial reporting standards? The second is any industrial specific reporting requirements, think banking and insurance, which often have extra rules on top of the general framework. Okay. And the third is the location of entities components. For example, the entity might have overseas branches, which affects how auditors plan to gather evidence across locations. All three of these shape just how wide or how complex the scope of the audit is going to be. All right. Step two is ascertaining the reporting objectives of the engagement. This is really about the auditor asking, what do we need to deliver and by when? The first piece is reporting deadlines. Okay, the dates by which the audit opinion and any other reports need to be issued. This derives the entire audit timetable, working backwards from that date. The second piece is nature of communications required. For example, what needs to be communicated to the management, to those charged with the governance, and to regulators. And when getting these objectives clear, early on means that the audit team can plan a realistic timetable instead of scrambling near the deadline. Step three is considering the key factors that will determine the focus of the audit team's efforts. There are four of these worth calling out. First, materiality thresholds, the levels the auditor sets for the financial statements as a whole, and sometimes for particular classes of the transactions or balances. Second, the high risk areas of the audit. The areas where the risk of material misstatement is greatest, which need closer attention and often more experienced staff. Third, the audit approach. For example, whether the auditors plan to rely on entities' internal controls when designing further procedures or take more substantive approach. And fourth, recent developments. For example, the application of new IFRS or new government regulations can have a significant impact on amounts or disclosures in the financial statements. These all need to be weighted at planning stage so the strategy reflects where the real risk actually sits. Step four is considering the results of preliminary engagement activities and, where applicable, where the knowledge gained on the other engagements performed by the engagement partner for entity is relevant. In practice, this has two parts. First, the results of preliminary engagement activities. The findings from the work the auditor does right at the start of the engagement before detailed planning begins, which can shape the overall strategy. For example, issue that come up when considering client's acceptance or continuance. Okay. Second, relevant knowledge from the other engagements, whether applicable or what the engagement partner already knows from other work they have performed for this same entity. For example, insights carried over from the prior year's audit. Bringing this knowledge in early means the strategy is built on what the team already knows about the client, not from the standing start. So now we have covered scope, reporting objectives, the factors that focus the audit, and what the team already knows from preliminary work and prior engagements. That brings us to the fifth and final step, that's resourcing. Once the auditor has all that in place, they are in the position to decide exactly what resources the engagement needs and when. Let's look at what that decision actually involves. Deciding on the nature, extent, and the timing of resources really comes down to the four practical questions. Who, where are the experienced staff needed? For example, the auditor would deploy their more experienced people on the high risk areas we just talked about. Then how many staff should be allocated to specific areas? For example, extra staff might be needed for attendance at year-end inventory count. And then when are those resources actually needed? For example, the audit might need more staff at the final audit than the interim audit. And then how are those resources directed and supervised? For example, this covers the timing of team briefing meetings, the manager and partners reviews of the work performed by the team. So answering these four questions is really what turns a strategy into a workable staffing plan. Let's quickly recap. The overall audit strategy sets the scope, timing, and direction of the audit, and it guides the development of more detailed audit plan. It's built by working through the engagement's characteristics, its reporting objectives, the factors that focus the team's efforts like materiality and risk, and relevant results and knowledge from the preliminary and prior engagements. And all of that leads to the resourcing decisions. Who is needed, how many people, when they are needed, and how their work is directed and supervised. Thanks for watching this video and see you in my next video.